However, do you notice that, in fact, all the bonds are being sold since January 2022? Because the yields are in general increases for all bonds across 2 to 20 years maturity. If the bonds are sold, should we consider as risk on? Then why we just suffered a recent deep correction since January this year? Where does the money go? Hello everyone, last video we talked about how to combine two bottoming signals to anticipate a bottom. Is there a way to anticipate a market top? Yes, today I'm going to introduce a macro indicator, yield curve. Please make sure to watch until the end as I will give the most updated yield curve, recession and the market update. First, we need to understand the relationship between yield curve, recessions and stock market. Let us start with recession first. Since year 1980, there are 6 recessions in the US. Year 1980, recessions from Jan to July 1980. Year 1981 to 1982 recessions from July 1981 to November 1982. Early 1990 recession from July 1990 to March 1991. Early 2000 recession from March 2001 to November 2001. Great Recession from December 2007 to June 2009. The most recent one, COVID-19 recession from February 2020 to April 2020. Okay, so what is recession? The most popular and the easiest to understand was 2 consecutive quarters of declining GDP. History shows us that recessions have occurred for many reasons, but typically are the result of imbalances built up in the economy that need to be corrected. These include rising interest rates, inflation, and commodity prices, as well as anything that hurts corporate profits, which may trigger higher unemployment. Then, how stock market responds with recession? In fact, 5 out of the 6 recessions since year 1980 fall into bear territory. Stock prices are influenced by many factors. One key issue is the strength or weakness of the underlying economy. When the economy is strong, consumer and business spending increases and corporate profits improve. Greater profits support higher stock prices. Conversely, when economy activity slows, spending declines, profits are reduced, and stock prices fall. The stock market typically continues to decline sharply for several months during a recession. Okay, so now we know during recessions, stock market most likely will be going down, and high chance that it will fall into the bear territory. Next, let us look on the relationship between yield curve and recession. Understand bond and yield. But before that, we need to understand the term bond. In this context, we will be focusing on Treasury Bonds, which are government debt securities issued by the US federal government that have maturities of different terms. When we buy the Treasury Bond, we are lending our money to the government. We will be paid a specific rate of interest during the life of the bond and will be repaid the principal sum when the bond matures. Bond prices are inversely translated to the rate of interest or yield. When the demand of a bond is high or many buyers, prices of the bond rises, yields then drop. By contrast, when many sellers are selling the bond, prices of the bond drop, yields then rise. How about the maturity period of the bond and yield? If you buy a 2 years bond or 10 years bond, which one do you think will give you higher yield? Of course, since I park my money longer, I should expect a higher yield, right? Therefore, 10-year bonds should yield more than 2 years bond. If we plot the yield of 2-year, 5-year, 10-year, and 20-year bonds, we will get this graph. This is called yield curve. We can see that in general, longer term bonds bring us higher yield. Let us see a typical normal bond table. On 1st of March 2022, yield of 2 years Treasury bond is 0.78% and the yield of 10 years Treasury bond is 1.63%. The difference of 0.78% and 1.63% in this case is 0.85%. It's called yield spread. Why bond yield is important? Bond market is able to tell us valuable insight into the risk appetite of the market. In general, in a risk-on environment, investors are greedy and investors tend to sell bonds in favor for better returns in the risk market, such as stock market. Money flows from bond market to stock market. Bond prices therefore drop, raising yields, and stock market rally. In addition, during a risk-on environment, investors generally use short-term bonds as hedges against their position in the risk market. This causes short-term bonds will not be sold as much or may even be bought out as an additional hedge. Therefore, the yield of short-term bond normally does not increase a lot or even decreases in the bull market. The yield curve is mostly steep in this period. A steepening yield curve represents long-term greed in the risk market. In contrast, if the risk market continues to rally and break new highs again and again, doubt will creep in on the sustainability of the rally. Investors or big institutes start to take their profits and then look for a safer but higher return. For example, long-term bond to park their money. The market is starting to turn into risk-off environment. Money flows from risk market, such as stock market, to the bond market. In addition, when the short-term bond is maturing, investors may reinvesting into long-term bond, which yield better return. Consequently, prices of long-term bonds will rise and yields fall, while prices of short-term bonds will fall, causing their yield to rise. This will narrow the spread, and the yield curve is flattening. A flattening yield curve signifies medium-term down. However, what if the investors are feeling huge uncertainty or fear? The burst process will be accelerated. Investors buy a lot more long-term bonds, push the price even higher, or pull the yield even lower, causing long-term yields to below the short-term yield. This resulted in an inverted yield curve, which is a sign of weakening economy and possible recession. Inverted yield curve is a signal of extreme fear in the risk market. Also take note that normally investors weigh more than on the 2 years and 10-year yield. When the risk market recovers, long-term bonds will be sold off, sending price down and yields out. Short-term bonds will also be bought as hedges for profitable positions to the risk market, causing prices to rise and yields to fall. The yield curve is in the process of normalization. Next, let us see the different scenarios on how a yield curve may be flattening or inverting. Each method of flattening signifies a different level of doubt and fear. The first one, pivot on the middle. The short-term yields rise while the long-term yields fall. This is the earlier example of the flattening curve that I have described above. The summary is shown here. Second, pivot on the back. The short-term yields rise while the long-term yields fall. When this happens, it signifies a drastically short-term bonds are drastically sold off. This represents the investors sell off their risk market investment and short-term bond to seek several avenues of income, such as cash. Pivot on the front. The short-term yield holds while the long-term yields fall. This happens when investors rush huge sum of money into the long-term bond, sending prices out and yields down. This represents a huge amount of long-term fear in the risk market. Yield curve and recessions. The history told us that when the yield on 10 years Treasury bonds dips below the yield for 2 years bond, a recession has followed. Thus, this concludes the loop: inverted yield curve, recession, market dip or crash. It is definitely not a good sign when the yield curve is inverted. So now, what happened to the today's market? On 31st March, the 2-year Treasury yields tops 10 years rate again. Yield curve is inverted. Yield of 2-year Treasury bond is 2.462%, while 10 years Treasury bond is 2.39%. Let me plot the yield curve on the first day of January, February, March, and April 2022. These are the observations. We can see that the yield of 2 years Treasury bond rises significantly compared to the 10 years yield. This is pivoting on the back. However, do you notice that, in fact, all the bonds are being sold since January 2022? Because the yields are in general increases for all bonds across 2 to 20 years maturity. If the bonds are sold, should we consider as risk on? Then why we just suffered a recent deep correction since January this year? Where does the money go? The main reason is the issue of inflation. Inflation is a bond's worst enemy. Inflation erodes the purchasing power of a bond future cash flows. Typically, bonds are fixed rate investment. If inflation is increasing or rising prices, the return on the bond is reduced in real terms, meaning adjusted for inflation. For example, if a bond pays a 2.5% yield and inflation is 2%, the bond's real rate of return is 0.5%. And we know that the current inflation is higher and higher. Supply chain issue, Ukraine-Russia war, pandemic, surge of oil price, sanctions on Russia, and the counter sanctions. All of these contribute to the inflation. Investors are fearing of the inflation will erode all the yields of the short-term bond, and thus they are selling crazily and push the yield higher and higher. And in fact, Fed got inflation badly wrong, and its move to control the inflation is too late. Thus, with the rising of inflation, bond is no longer attractive, and therefore investors are selling them. Then where does the money go? Money goes into cash, which is also considered as a safe haven. From this chart, on 14 March 2022, UUP, one of the long US dollar ETF, is showing a positive growth of 3.28% since January. The 10 years Treasury Bond ETF, IEF, suffered a 5.12% decline. Stock market, both SPX and Nasdaq Composite Index, showing a decline of 4.62% and 17.63% respectively. Conclusion: based on my research, the investors are fearful that the inflation will be out of control and therefore selling the short-term bond tremendously, push the yield high enough to invert the yield curve. However, the investors are also down on the risky market as they park their money on USD. If core inflation remains high and inflation expectations rise, the Fed could be left with no choice but to quickly move rates to neutral or restrictive levels. A more abrupt adjustment path could take a big toll on GDP, including through tighter credit conditions and a sharp rise in long-term US bond yields, which then lead to recession. CNBC Fed survey shows that the probability of recession next 12 months is 33%. And from the initial part of this video, recessions most likely will hit the market badly and high chance of enter a bear market. What should we do? Oh well, hopefully this video could give you some insights and basic knowledge on the yield curve. I will share my strategy to protect myself if the recession is coming. Please remember to subscribe my channel and turn on the notification bell so you won't miss my strategy video. Thank you and see you in the next video.